Good day, ladies and gentlemen, and welcome to our class today on technical indicators and specifically technical oscillators. Now today we're going to be talking about what are and why are Forex technical oscillators and indicators important. Now oscillators are simply one of the types of technical indicators, and all of this falls into the field of technical analysis. Now remember, technical analysis is a very broad term. This covers everything from looking at a price chart to putting levels of support and resistance, or looking at triangles on a chart pattern, or using oscillators and indicators, or using things like trend lines. But anytime you use a chart, and anything you put on your chart is the field of technical analysis. And in that field, one of those sectors are technical indicators. And some of those indicators are oscillators. Now, oscillators are one of the most interesting grouping of technical indicators. They are designed to signal overbought and oversold levels. Oscillators are a family of indicators that go beyond the mathematics. They focus on one important thing, and that is momentum, or more specifically, changing momentum. So before we delve into oscillators or how best to use them, let me save you some unnecessary pain. Let me tell you first what oscillators aren't. Some traders believe that oscillators are some sort of magical index, but they're not. Rest assured, when I tell you that they are not, oscillators' main use is not to tell you whether to buy or sell. They're not going to tell you whether you're going to make money. They're not going to help you get rich. Rather, they alert you to when it might be a good time to execute a buy or a sell strategy. Now, that is a very big difference. They're alerts. They give you a piece of information about what might be happening. Those who attempt to use oscillators as an ultimate buy or sell signal should be ready to learn a tough lesson. Those that will use them to fine-tune their timing, however, will find that oscillators are a very powerful tool. Now, indicators are the most useful tool of all technical analysis visual aid. They define precise moments to sell or to buy. In finance, technical analysis has a lot of different indicators, and they're used, most of them, in many different ways. We have trend following, we have oscillators, we have momentum oscillators, we have speed oscillators, we have speed indicators, momentum indicators, volatility indicators, volume indicators. So Forex oscillators show us that the moments when the Forex market reaches its limit in any direction and an opposite correction of the trend becomes extremely probable. That's an important word, probable. So before we go on, let me pop up some charts, and we'll help you look at these things so that you understand what we're talking about. Okay. On this screen, down here, we have RSI. RSI is a technical indicator that is also an oscillator, because it oscillates just like your radio. Remember, if you're old enough, you remember when your radios oscillated between frequencies. Okay, this is called a bounded oscillator because it bounces between 0 and 100 and will always come out between 0 and 100. We have other oscillators. Like here we have MACD down below, and we also have RSI again. Okay. Now, some of these are oscillators, some are indicators. Okay, well, they're all indicators, but some of them are oscillators. When the price or the calculation of the indicator bounces up and down, up and down, up and down, it's an oscillator. It's like waves moving up and down between a preset outcome. Where MACD here is a technical indicator, but is not necessarily an oscillator, because MACD calculations can be anything. So it's an indicator as opposed to an oscillator. So again, here we have MACD down below. Okay. Almost all oscillators are placed on your chart down below, and they all fall under the field of technical indicators. One of the most popular oscillators is stochastics. Now what RSI shows us, or stochastic shows, or an oscillator shows us, is when price becomes overbought or oversold. And that's an important piece of information. Okay. So this simply means that the price will stay stable or even slide down for some time because traders are willing to fix their profits. And during negative corrections, new traders will enter the markets. Some analysis of Forex indicate oscillators consists of two basic elements. First, discovering if the Forex market is in short-term overbought or oversold conditions. And second, in determining the dispersion with the price as a value of the oscillator approaches its extremes. Oscillators are most beneficial when the Forex charts are not showing a definite trend in either direction. In trending markets, oscillators should be taken with maximum caution, provided that because it provides false signals generally stand for strengthening of the trend. Because an asset can reach an overbought or an oversold condition, but that doesn't mean it's going to reverse, and especially in a trending market. Sometimes speed of the trend can push it into an overbought situation, but the market can continue going up and up and up and up and up. Okay? And the oscillator will correct itself. When the markets are moving in a slower uptrend or downtrend or in a sideways movement, an oscillator will help you predict what is about to happen. So an oscillator is an object or data that moves back and forth between 2 points. In other words, it's an item that is going to always fall somewhere between point A and point B. Think of it when you hit the oscillating switch on your electric fan. Think of your technical indicators as either being off or on. More specifically, an oscillator will usually signal buy or sell, with the only exception being instances when oscillator is not clearly at either end of the stage. Now, oscillators most of the time spend their time between the boundaries that they're not telling you anything. Like for instance, stochastics or RSI, we have boundaries, and it might be 80-20 or 75-25, but when the oscillator is calculated as falling in those zones, it's telling you absolutely nothing. It's when it goes above the 75 or the 80 point or below the 20 that is telling you the market is overbought or oversold. So stochastics, parabolic SAR, and relative strength index are all oscillators. Each of these indicators is designed to signal a possible reversal, where the previous trend has run its course and price is ready to change. A change in momentum is often a signal that the current trend is weakening. For this reason, traders need tools that can measure market momentum. So, MACD falls in that because MACD is an indicator of an indicator and gives us several different choices. It gives us our MACD histogram. It also gives us our MACD signal line or MACD trigger line. So part of the MACD, or one of the uses of MACD, is overbought and oversold. Okay. Then we have stochastics. This is one of the most interesting indicators in the oscillator family. What I like about this indicator is that it essentially gives you a two-dimensional picture of overbought and oversold and momentum. Unlike MACD, that's not always as accurate on overbought and oversold levels. The idea of the stochastics oscillator is twofold. First, it's normalized from 0 to 100. In other words, it'll always calculate out between those two. Anything below 20 is oversold, and anything above 80 is overbought. And please do me a favor while you're listening.
Indicator 1, RSI. The relative strength index compares the magnitude of recent gains to recent losses in an attempt to determine overbought and oversold conditions of an instrument. As you can see from the chart, the RSI ranges from 0 to 100. An instrument is deemed to be overbought once the RSI approaches the 70 level, meaning that it may be getting overvalued and is a good candidate for a pullback or reversal. Likewise, if the RSI approaches 30, it is an indication that the instrument may be getting oversold and therefore likely to reverse. Traders will often use the RSI either coming back out of its overbought or oversold areas as a signal or partial signal to enter a trade. As we can see, the RSI is often accurate when indicating when a market will reverse. A trader using RSI should be aware that large rallies and drops in the price of an instrument will affect the RSI by potentially creating false buy or sell signals. Traders often combine the RSI with other indicator signals, such as MACD crosses. Indicator 2, MACD. The moving average convergence divergence is one of the most well-known and used indicators in technical analysis. This indicator is made up of two exponential moving averages which help measure momentum in an instrument. These moving averages and the changing distances between them become the MACD. Convergence simply means the moving averages are moving closer together, and divergence simply means they are moving away from one another. When the shorter-term moving average is above the longer-term moving average, this area of the indicator will show activity. When the shorter-term moving average is below the longer-term moving average, this area of the indicator will show activity. The center line, of which the MACD is plotted around, indicates where the moving averages are equal, and when the MACD passes through the center line, this indicates the moving average is crossing. The signal line, here in red, is a moving average of the MACD values themselves. Typical values for the MACD are 26 and 12 exponential moving averages and 9 for the signal line. The farther apart the moving average is, and the greater the momentum, the farther away the MACD will be from the center line. Traders use MACD and signal line crosses, such as these, to indicate momentum trades. You can see how these crosses often match up with market moves. Traders also use the MACD crosses to indicate when momentum is coming out of the market and may use it as a signal to exit a trade. Indicator 3, Bollinger Bands. A Bollinger Band starts off with a simple moving average. It then has two standard deviations plotted away from it. That sounds a mouthful, but the important part is because standard deviation is a measure of volatility, Bollinger Bands adjust themselves to current market conditions. When the markets become more volatile, the bands widen, move further away from the average, and during less volatile periods, the bands contract, moving closer to the average. The tightening of the bands is often used by technical traders as an early indication that volatility is about to rapidly increase, as volatility often follows periods of lack of volatility. The markets spend most of the time within the bands, and when the price action reaches the edge of the bands, it is often more likely to reverse and come back into the range. This is used as a signal by reversal traders to take a trade. This is similar to the oversold and overbought conditions of the RSI. Indicator 4, Super Trend Indicator. The Super Trend Indicator is an excellent indicator of trend direction. It can be used as a foundation of a trading system that is based on trend following. One of the most popular ways to use this indicator is to enter the market after a pullback. For example, if the market is on a downtrend, indicated by red, wait for a green pullback and then re-enter the market once it turns red again. The same can apply in uptrending markets. Here we can see how this indicator accurately tracks market trends. It can be refined through the settings to match the specific instrument. Indicator 5, Confluence. The last indicator isn't a new one, it's indicator confluence, which means to use multiple indicators and their signals to take a trade. Here we have the RSI and MACD we looked at. We have the RSI moving into overbought territory here. Remember that indicates the market will reverse. However, we want to help us filter out false signals on the RSI, so we also look at the MACD to give us confluence. We can see it is indicating the momentum has come out of the market, as far as the market rallying or going up is concerned, and we have an MACD cross here. A signal to enter this short trade could be waiting for the RSI to come back out of the overbought and also waiting for the MACD cross. We can see that those combined signals are an indication that captures this trend. You can also use the opposite signals to indicate when the momentum is coming out of the market and it's more likely to reverse and the market to retrace back up the opposite direction of our trade, and therefore is an exit signal. In addition to the RSI and MACD signals, we can add further confluence to this trade with a Bollinger Band and the super trend indicator. We can see the market has hit the top of the Bollinger Band here, but we could also wait for the super trend indicator to change red here before taking the short trade. So now we have the confluence of four indications. We have an RSI coming back out of overbought, we have an MACD cross, we have the market going to the edge of one of the deviations on the Bollinger Band, and we also have the super trend turning back to red.